Robert, let's first kick off on your views on what's taking place in Europe and how key this is for markets right now. We know that Spain had a debt auction today. We saw adequate demand coming through for that. That, of course, easing some fears about Europe. But how pivotal would you say is the Spanish economy right now? And, of course, Italy also in focus.
Very. Really, the epicenter of risk sentiment largely emanates from Europe. Europe has a clear flavour of austerity, while we look to the US for growth. Europe largely determines when these mini cycles in equities kind of start and stop. Italy and Spain are often grouped together. We can address Spain on its own because it is probably in a little bit more of a dire straits than Italy. The current run rate of business spend in Spain was minus 4% year on year in the last quarter. So we really need to kind of monitor the run rate of Q1 and Q2 GDP outturns. The official forecast for the year is minus 1.7% recession for 2012. That could easily be exceeded by a 4 percentage point. Now, the more that Spain gets stretched out, the more stresses you'll see on the European level in terms of the firewall capacity, and that kind of takes away a lot of the kind of risk sentiment that you see from the US equity markets and worldwide. By and large, you don't really need, from a global perspective, Europe's never been a leader of the global economic cycle. It's much more the US led, so there's much more comfort from that, and I think we're in a much better position now in spring in 2012, spring in Europe, maybe autumn in Cape Town, than we were in 2011, 2010, where we saw relatively good starts to the year and a quite sharp 15-20% pullback in equities. I don't think that's going to be the case this year. We have had the honeymoon that is the LTRO, the spare trillion euros that the ECB found down the back of the couch is largely pre-funded the banks to the end of the year, and the banks domestically in Spain are buying domestic sovereign debt, so they are bidding for these auctions. You mentioned that the recent auction today was relatively well bid, not overwhelmingly so, and I think because of that and the rise in the political risk premium, especially with the French elections just around the corner, probably means that Q2, calendar Q2, will probably be quite choppy. So I would have thought you probably might get flat to negative eventual performance outturn in the second quarter, despite relatively that's equities that you're looking at. First quarter results.
That's equities that you're looking at right now. That's global equities, and you did mention the United States right now, and there are varying views that we have on the state and the health of the economy. Speaking to an economist today from a mixer, they were concerned around the fact that we've had kind of choppy data starting to come through from the United States. What is your evaluation of the recovery and the state of the recovery in the US relative to other recoveries and other cycles?
Versus other cycles, everyone's recovery is very poor, quite clearly. US strength is only a relative measure. It is at half speed. In previous 10-quarter recoveries, you probably expect around about 4.7% growth. You're getting about 2.4% this time around. One of the potential hurdles, Italy and Spain obviously a potential hurdle, Chinese real estate is a potential hurdle. The US slowing down to a 1% kind of run rate lower is another hurdle. The US housing, which has been in the background for quite a long time and has been a negative contributor to growth, should probably turn flat and potentially even positive in 2013. So that will no longer be a drag. Rents are rising, inventory levels are finally coming off. So you might actually start seeing a return on the consumer a little bit. The US consumers, better than the other households in Europe that were stressed, have actually paid down or even had debt written off. So they've gone a certain way of cleansing themselves that hasn't been seen elsewhere. So there's probably a little bit more strength in the US recovery to come. Economic indicators have rolled over globally, and particularly in Europe. That's quite a natural thing. So I think the slowdown in the US currently is more cyclical. You probably see a bit more of an upturn as the year progresses.
What is your view on the comments that we have around the European sovereign debt crisis being a dress rehearsal for a much worse debt crisis in the US as it starts to kind of rein in spending and get its deficit under control?
Listen, it's a beautiful sunny day in Cape Town today, so I don't want to necessarily ruin the late evening for your viewers, but we're really talking about an austere decade, taking us to 2020 in my opinion. Europe is the leader, maybe forced we're already 2 years into an austerity cycle which has got 2 or 3 strong years to go. The US budget announced by Obama in February is year on year 2013 to 2012 is $430 billion less, which is by and large the size of the South African economy, which is pulling back. Now that can't be missed anymore. Once the election's out of the way by the end of this year, the US will go into some sort of fiscal austerity 2013 for a number of years. And if you're going to look at it more globally, China will quite possibly have quite a severe pullback and recession, maybe 3 or 4 or 5 years out, largely because it is an investment-led economy, and we've never had an example before of that train not hitting the buffers. So you're going to see 2020 at different regions and different timescales will all take turn in this.
Robert, between you and Lindsay Williams, who of course is the co-anchor in the morning show, telling me about how amazing Cape Town is, I don't really know what to do because there's nothing much I can do about being in Joburg. If yes, rubbing it in that it is a very sunny day in Cape Town right now. Just your views on what this all means for the equity horizon in South Africa. Where should you be putting your money in equities right now with kind of a choppy outlook in terms of the recovery globally, and perhaps South Africa very much geared towards Europe still, and of course Chinese demand and just general market mood?
For South African equities, and simple analysis, I follow more global developed markets. Naturally, you can't cover everything. When I did start looking at this trip and South African equities, they move much more closely with the US market. US market, we've got a 1470 target on the S&P, so you can add a level of beta to that and apply that to the JSE. In the US, in South Africa, you have obviously got relatively weak demand at the moment. The rand is obviously hurting a lot of households and corporates. The housing market has been weak. The banks, in terms of the opening intros, you mentioned the show, in terms of deleveraging impact in South Africa, the banks vis-a-vis the rest of the world, the US and in Europe, are relatively strong. They're weak in liquidity perspective, but in terms of capital, they are strong. Loan growth is relatively mute, apart from unsecured lending, which looks like it's in some sort of bubble. But by and large, I would have thought, once the global equity markets settle down a little bit in Q2, because I think it will be bumping the next couple of months, I think probably the JSE will rise a lot higher in the second half of this year.